Thanks for tuning into the Finance News Network. I'm Jessica Amir. Today I'm with Glennon Capital's Small Companies Portfolio Manager, Tim Powditch. Hi Tim, and welcome to the network.
Hi Jessica, thanks for having me.
Well, thanks for coming along to Melbourne. So first up, for those who haven't heard of your listed investment company, just give us a quick introduction.
Okay, the listed fund listed around 3 years ago. It's now worth just under $50 million. We're stock pickers at Glennon Capital. We don't tie ourselves down into any particular style, although we like to find growth in our investments and we need to have value in that growth. We've been paying franked dividends for since inception and we're currently yielding around 4.3%.
Now let's zoom in on the small cap segment of the market and why it's so unique. What can you tell us?
We like small caps because they tend to outperform if left to their own devices, as they did in 2017. In 2018, they've been performing in line with the large cap stocks because the market's been influenced by outside forces. We like small caps because they offer growth. If you compare them to the top 100 companies, which grow at GDP, small caps are striving for that growth. We also like them because they're diversity. If you're buying small caps, you're getting a range of companies in a whole lot of innovative areas, whereas in large caps, you tend to get the banks, BHP, Rio, Telstra, and maybe a couple of large retailers. Small caps also tend to outperform industrials over time, so we do prefer industrials. But at the moment, the whole market's been sold off, and so there's good value in the small cap market.
Now to the fund, just tell us about the composition or what it's made of.
Well, the Glennon Fund typically operates around 35 stocks. That's pretty concentrated. We prefer industrials over resources, although we do hold some producing resource stocks, which are earning revenues. At the moment, the fund's probably concentrated to a few sectors like mining services on the back of the resurgent resources industry and the inflation being caused by the East Coast infrastructure spend. Stocks like Macmahon, Emeco, Alliance Aviation. We also have quite a good skew towards Australian stocks that are performing internationally, and that's helped by the lower A dollar, but also the innovation and these capital light services businesses such as Apollo and Afterpay Touch, and Lovisa and City Chic.
Thanks, Tim. And how has the fund performed?
Well, since inception, which is a little over 3 years, the fund has returned around 12% per annum. That's if you reinvest the dividends over that time. The NTA, including cumulative dividends, is $1.16 and the stock's trading at 94 cents.
Thanks, Tim. Now, what's your outlook for the fund?
Well, look, the macro environment is quite benign. Unemployment's at 6-year lows, inflation is low, GDP growth's topping 3%, interest rates are still pretty low. Stock picking is key for us. Earnings should be solid, but we think investors will be shy for some time. It may be a flat outcome, so we certainly need catalysts in our investments. There's been a valuation shift in the market, obviously, and this allows us to look further into the bigger end of the small cap market and less towards the higher risk micro cap portion of the market.
Now, Tim, what's your message to investors in terms of long-term wealth creation, and what are the principles that you follow?
We look at a 3-year plus horizon when investing in stocks. Every good stock has a start, middle and an ending. In other words, you need the right valuation at the beginning. When you invest in the stock, you need the right reasons to hold that stock over time and you see the share price appreciate, and you need the right valuation to when you should quit the stock. Within the macro environment, of course, we would look for growth in most of our stocks. We like to have a value element in that growth. Now that could be a pure value element like a low PE and a high yield, but that must come with growth. Or it could be a stock that doesn't appear good value at the moment, but it might show great value in 4 or 5 years with rapid growth. And as I said before, stock picking must have catalysts. A good example is Macmahon Holdings. Macmahon Holdings is a contract mining services business. It's been around a long time and it's had some tough times in the past. Why we like it is because it's starting to prove itself with new management. It's through its recovery phase now, and the valuation should improve in the market as it continues to prove that. It's showing reasonable growth. It has a pipeline of $7 billion, but importantly, $6 billion of that pipeline is with existing customers or on existing contracts. So the opportunity for Macmahon is quite large. And it has an element of surprise too, which we think is positive. It has a profit share arrangement with some of its contracts that could certainly boost earnings over the next couple of years.
And what would you like to leave with investors today?
Look, I think every equities portfolio should have an element of small caps in there for the growth and diversity they bring. And after the recent market corrections, small companies happen to be a lot cheaper than they were, quality small companies. And the best way to invest in small companies is through an experienced stock picker like Glennon Capital.
Brilliant. Thank you so much for your time, Tim Powditch.
Pleasure.